Hey, what's up everyone? My name is Ale. Welcome back to my world of stocks. So on occasion, I would say maybe like once a year or so, I like to take a look at the at the richest, largest, most influential, most respected investors out there and analyze their stock market portfolios. And in today's video, we're going to be taking a closer look at the legendary Warren Buffett. Now, I believe Buffett owns like 60 something different stocks, so there are way too many for me to go through every single one of them in this video. Instead, what I like to do is grab the 10 largest holdings of those portfolios and rank them from best to worst and give my personal opinion on each one of them. And of course, as always, let you know if I plan to buy any of them myself anytime soon. It's always a fun little series that we do here on the channel. I hope you guys enjoy it. If you do, hit that like button. Drop a comment down below as well. Let me know which investor or even hedge fund you would like me to review next, taking a look at their portfolio. But with all that said, let's go ahead and jump straight into this. We're going to count down from 10 down to 1, from smallest to largest, and I'll continuously rank these stocks as we go through the list and give my opinion on each one. Let's go ahead and jump straight into it. Okay, so starting with stock number 10, that's going to be DaVita. Ticker symbol is DVA, at about 1.4% of his portfolio and valued at around $3 to $4 billion. And by the way, I'm referring to this as Buffett's portfolio to keep things simple, but it's actually his company, Berkshire Hathaway, but most of you already know that. Also, keep in mind that a stock doesn't necessarily have to be purchased by Buffett himself, because he does have other decision makers on, in the company, but for the most part, Buffett is or was behind, I would say, a lot of these. Okay, now if you've never heard of DaVita, they're a healthcare company that specializes in kidney care, serving over 200,000 patients and operating over 3,000 dialysis centers across the United States and 10 other countries internationally as well. And the bullish case for them is that as the baby boomer population ages, DaVita should be one of those companies that benefits from more seniors relying on them more heavily and therefore boosting their sales. According to the United States Census, all baby boomers will be at least 65 years old by 2030. So that adds like a little more security to the company because you have that tailwind to kind of look forward to. Still, financially, DaVita has been a very mediocre company, and that's putting it kind of nicely. They can never seem to break north of 12 billion in sales or 1 billion in profits, always hovering just a bit below that. And when you look at their revenue growth, you're typically talking about only around 1 to 2% growth at best. So pretty low growth company, I would say. And that's resulted in a very slow moving stock over the years, although it really shot up in 2020 by over 50%, leaving them up about 48% in the past 5 years. But even with that recent surge, it's still around 40 to 50% cheaper than the sector, according to Seeking Alpha. So I can see why Buffett owns it, since he does tend to like a lot of those kind of slower moving, kind of like a little more boring kind of companies, but relatively stable ones with low valuations. I'm not interested in this one myself though, because it's a little bit too low growth for me, and it doesn't even pay a dividend, which those are probably the two things that I get the most excited about in my stocks. But overall, I would say that this is a perfect example of what I like to call a middle of the road type of stock. Definitely not a bad one, but also not a very exciting one either. So for now, I think I'll put them right around the middle at number 5 and then readjust it as we look through some more stocks. Okay, now moving on to stock number 9, that's going to be Chevron, ticker symbol CVX, at about 1.5% of his portfolio and worth over $4 billion in what I'm pretty sure is a very new position for him. And of course, you guys know Chevron, they're an oil and gas company. You've probably visited one of their many gas stations at some point, and there's actually a ton of really interesting things about them. For one, they're the only oil stock left in the Dow Jones Industrial Average after Exxon was removed last year. And while many oil and gas companies were going under or struggling heavily during the past couple years, Chevron was actually out there making moves. In fact, they actually acquired Noble Energy for $5 billion, increasing Chevron's already massive size by even more. Back in 2019, they were the third largest seller of gas in the United States, only behind Shell and Exxon. And while many companies were forced to cut their dividends, Chevron has actually increased theirs for 34 years in a row, and management has stated that they plan to protect the dividend at all costs, which currently yields over 5%. By the way, ignore that 5-year history on Seeking Alpha. I think it's a glitch, but the high yield cost them almost 100% of their cash flow, as you can see on their payout ratio. So that is an expensive dividend for them. And despite all their positives, the future of oil and gas isn't very bright in my opinion, as the world shifts to renewable energy. And it doesn't help that Chevron was already struggling before that, with both 2019 and 2020 being decline years for them in both their sales and profits. And to make matters worse, the stock has already largely recovered from the damage it took the past couple years and now sits near a 52-week high. So while I do think that Chevron is performing better than most other oil and gas companies out there, and I do also like the dividend as well, their stock price right now is just too high for me to want to take any kind of risk on them, as they trade for around 60% more an expensive price tag than the rest of the sector. So even though it's my favorite out of the oil and gas giants, I don't think I'll be buying this stock anytime soon, as I just have no interest in oil and gas stocks kind of in general. And because of that, I have to rank them at the very bottom of the list, since there's really nothing that would really convince me to buy into them unless I was specifically looking for like a short-term gamble or some sort of like swing trade. Okay, now moving on to stock number 8. That's going to be one of Buffett's favorite type of companies to invest in, and those are big banks. And this time it's going to be US Bancorp at just about 2% of his portfolio and worth over $6 billion. Now, I believe he first bought this stock back in 2006 and is now the largest investor in the company, which is famous for their many US banks locations and services. Currently, US Bank is ranked the 5th largest in America by assets, worth over $500 billion according to the Federal Reserve. So definitely a very large bank. And while Buffett has done a lot of selling in other banks recently, like in Wells Fargo and PNC Financial, he's only made very tiny moves on US Bank by comparison, which could be an indication that he still believes in them long term, or at least kind of likes them a little bit more than maybe some of the others. Either way though, considering the giant crash in 2020, the stock has actually performed relatively well over the past 5 years, up almost 40% in that time, thanks to a giant recovery soon after the crash. And even then, their valuation isn't too crazy, as this may be just a tiny bit higher than the sector median. Their dividend is also super nice at almost a 3% yield, with solid growth metrics to go along with it, like a low payout ratio, double-digit growth rate, and 11 consecutive years of growth. But I'm just not that optimistic about banks right now, with how horrible our economy looks in terms of unemployment, as well as the massive money printing that's been going on. And even with things relatively stable right now, US Bank is still expected to see a revenue decline this year, and on average typically only grows around 2% a year, which isn't super exciting. I get it, banks don't typically grow a lot and they're more of a stable kind of dividend play than anything else. And because US Bank does pretty well in those areas, I'll go ahead and put them ahead of DaVita for now in the number 4 spot, even though I don't really plan on buying any shares myself anytime soon. Okay, now moving on to stock number 7, that's going to be Moodys at over 2.6% of his portfolio. Now, this is a business and financial services firm famous for being one of the top 3 major credit rating agencies. You've probably seen them like maybe used on your credit report or something similar to that. And they've been held by Buffett, I believe, since 2001. And there's not really a lot to say about them. I think this is just one of those kind of finance companies that is really big, probably a bit too big or too heavily used by major institutions to ever really disappear. I mean, I'm not going to go through the list of all these different numbers here, but you're talking tens of trillions of dollars of rated debt and hundreds of millions of companies in their database. So overall, I just feel that they're a pretty reliable company for investing in, and you can definitely see that in their financials. They may not put up gigantic numbers like in the tens of billions, but sales and profits have been consistently solid over the years, and revenue growth continues to be positive even through this last recession. We're talking growth of over 12% last year and still above 5% this year and 7% the next. That's pretty damn good. On one hand, this is great news for investors that hate volatility, as the stock is up over 200% in the past 5 years, seems to rarely ever dip, and is currently trading at an all-time high. But on the other hand, that doesn't really leave many attractive entry points into the stock if you're new to it, which would be the case for me. Not to mention that the valuation is extremely high right now, as it's around 130% more expensive than the sector median. And while they do at least pay a dividend with some nice growth metrics on it, at less than a 1% yield, it's not likely to attract a lot of dividend investors either. So overall, I think I like them more than DaVita because of the consistently higher growth, but less than US Bank because USB has a cheaper valuation and a higher dividend. So I think I'll move DaVita down one slot for now, and I'll put Moody's just right below US Bank, kind of in the middle of all that. Okay, now moving on to stock number 6. That's going to be a stock that I actually just recently started purchasing myself, and that is Verizon. Ticker symbol is VZ. And I actually think this is a new stock for Buffett as well, but it already makes up over 3% of his portfolio and is worth close to $9 billion. So they've definitely been buying it, like fairly aggressively, it seems. And you guys already know a lot about Verizon. I talk about them a lot on the channel, but it's one of those big like telecommunication giants out there. It's a huge play on 5G, which they've been doing a really good job of expanding their ultra wideband services across the country. And of course, they're also a huge play on just the internet in general, especially through their fiber brand Fios that gained over 90,000 subscribers last quarter, up from just around 30,000 year over year. However, just like AT&T, Verizon has been struggling with losing video subscribers as more people kind of cut the cable cord. And because of that, coupled with the pepperoni recession, their sales have been struggling a bit, with 2020 being a slight decline. They're already on the recovery side of things though, with 2021 and 2022 expected to see growth of 4% and 2% respectively. And while that is pretty small growth, at least Verizon is a very profitable company, doing over $20 billion of free cash flow last year alone. That allows them to pay a mouth-watering dividend of over 4.3% and still maintain a payout ratio of less than 50%. Meanwhile, because the stock has stayed relatively flat over the past 5 years, their valuation is actually pretty good, as they trade for around 40% cheaper than the sector. I'm probably biased because I do own the stock myself, but I gotta rank this one pretty high just for that huge dividend and the low valuation alone. So I'll go ahead and put them in the number 2 spot for now, and I actually think they may end up in the number 1 spot depending on what other stocks are left on the list, but we'll have to see as we go. Okay, now moving on to stock number 5, that's going to give us the notorious food giant Kraft Heinz at over 4% of his portfolio and worth over $11 billion. And this is a very well-known company behind giant brands like Oscar Mayer meats, Kraft cheeses, Heinz ketchup, Capri Sun juices, Jello gelatins, Kool-Aid, Weight Watchers, Philadelphia cream cheese, Lunchables, the list just goes on and on. Anyway, with such popular names in the grocery space, you would think that this would be one heck of a stable and very consistently well-performing company. Perhaps that was the case back in the day, but more recently they've struggled to really innovate and adapt to changing market trends, especially with the rise of healthier options, and that's resulted in them kind of failing to attract any new customers and even retain their existing ones, which they always kind of struggle to compete with those like local grocery brands as well. As a result, sales declined in 2019, bounced back a little in 2020, but that was probably because of the pepperoni lockdowns where everyone was just like hoarding as many groceries as they could get their hands on. But then here in 2021 and 2022, they're already back down to revenue declines once again. Very unfortunate. To be fair, they have at least made some moves in an attempt to innovate a little. For example, they did acquire Primal Kitchen, which I actually really like myself for their paleo and keto friendly options, but this is a stock that despite currently trading at a 52-week high, they're still down almost 50% in the past 5 years. On one hand, that does leave them with a valuation that is around 25% cheaper than the sector and a very nice dividend of almost 4%, but they really need to start putting up some growth again if they hope to keep sustaining that dividend, which by the way, they've cut that dividend in the past, so we know that they're willing to cut it again if they need to. I do think Kraft Heinz is large enough to support a turnaround in the company, but it's going to take a lot of time, a lot of money, and some very strategic acquisitions. And until I see those things happen on a bigger scale, it's just too much of a headache for me to own this one at this time. So I'll put them in the number 7 spot for now, just under DaVita. All right, now coming in at number 4, that's going to be American Express at almost 7% of his portfolio. And he's actually owned this credit card giant for an extremely long time, I believe since the 60s, and he is currently the largest shareholder of the company, and his position is worth over $18 billion. That is very large. Now, I mentioned before that Buffett did some selling of financial stocks this past year, but despite owning Amex for such a long time and having such a large position in it, he actually didn't do any selling at all of it. So my guess is that Buffett still believes very strongly in this company. As far as the business goes, I'm sure you guys know of them. I actually have an Amex credit card myself, and they usually hold around the third largest market share in the United States by purchase volume. And because Visa is so dominant, it actually leaves them a little more room for growth than you might expect for such a large company. 2020 was a heavy decline because of the recession, but typically they see double-digit growth or at least pretty close to it, and that's very consistent, with a nice rebound of around 9% this year of growth and another 12% expected next year. So you can see how they're kind of bouncing back. They can kind of bounce back fairly quickly from those big dips. So if the price is right, this is actually a stock that I would love to own myself, but unfortunately the price is just not very attractive right now, as they do currently trade for basically an all-time high. If they were still under that $100 range like we saw last year, then I would say, yeah, this is a no-brainer, definitely pick it up. But at current levels, their valuation is anywhere from like 70 to almost 200% more expensive than the sector. They do have a nice little dividend of about 1%, but that's not enough to make up for that super rich valuation. And the fact that this is still a finance-related company at a time when our economy is still weak and highly unpredictable, I'm just left with very mixed feelings on it. I think I'll put them right under Moodys for now, since I feel that Moodys has very similar pros, but it's just a tad bit more consistent in terms of performance. And I'll move the others down to kind of fit it in, even though I hate how low DaVita is getting on this list, because I actually think that they're a better company and stock than the ranking would have you believe, but that's just kind of how it's going. Okay, now moving on, we are now breaking into the top 3 largest holdings of Warren Buffett, and coming in at number 3, that's going to be Coca-Cola, ticker symbol KO, at over 8% of his portfolio, which he's been holding on to since all the way back to the 80s. And as most of you know, this is a really slow-moving stock, which has been a reason why a lot of investors, myself included, just felt like it was maybe a little bit too boring to own. In the past 5 years, it's only climbed by about 20%, and despite it looking volatile on this chart, it's really only jumped around that $45 to like $55 range. Granted, it still tends to leave you with reasonable entry points because of that little kind of volatility in that range, since even right now at their 52-week high, their dividend still yields you over 3%, which is very nice. And that's probably the best reason to own this stock, is for that dividend that has been grown every single year for close to 6 decades in a row. So that is very hard to beat. Still, while they do sell more beverages than just Coca-Cola, they're not nearly as diversified as something like maybe PepsiCo, who also sells some of the most popular solid food snacks, and that means much less consistent sales for Coca-Cola. 2020 was a decline of over 11%, while PepsiCo actually saw growth. Pepsi also brings in more money and pays a very similar dividend as well. This isn't meant to be a comparison to PepsiCo, because my bias would say Pepsi is better because I own PepsiCo stock, but I bring it up because they're mostly the reason why I haven't owned Coca-Cola yet myself, is because that PepsiCo is out there. I know it's out there, and I feel it's a better option in terms of a stock. I gotta admit though, I may buy Coca-Cola in the future just for that dividend, because I do actually really like it. But for now, I think KO definitely deserves the number 3 spot just behind Verizon, and it's a stock that I think will remain pretty high up on my watch list. Okay, now we are now down to the last 2 stocks, and coming in at number 2, that's going to be another one of Buffett's financial stocks in the giant bank, Bank of America, ticker symbol BAC, at over 11% of his portfolio, and that's at over 1 billion shares, which is worth over $30 billion. That's a lot of money. Now, I showed you guys this image before of the largest US banks by assets, and we got to come back to it again here, because Bank of America is currently the 2nd largest bank, only behind Chase, which is actually the only bank that I own myself in terms of a stock. But anyway, Bank of America, they're at about $2.3 trillion in assets, which is very large. And with their giant network, they're able to bring in very large sales and profits. We're talking usually around 90 billion in sales and almost 30 billion in profits. But when financials are high, the growth can sometimes be low, and Bank of America is actually a pretty good example of that. In fact, with the economic downturn, it's going to take them until 2022 just to break north of the sales that they made way back in 2018. That's because revenue plunged by 5% last year, and even then, the recovery is still only less than 3% growth this year. That hasn't stopped the stock from surging though, as it skyrocketed from last year's crash to now trading for an all-time high, which means you can forget about getting any kind of value as the stock is currently trading around 5% more expensive than the sector, and the dividend is also pretty low at less than a 2% yield at these levels. Still, Bank of America is an interesting stock because it's a very profitable company and their dividend actually has some very nice growth metrics on it, like a low payout ratio of less than 25% and almost a 30% 5-year growth rate. I feel that Bank of America is extremely similar to US Bank in terms of valuation and performance, but Bank of America brings in larger profits, which I think can help them more during downturns. So because I'm worried about the current economy, I'll give a very tiny edge to BAC and put them just barely ahead of US Bank and move the rest of the stocks down. Just FYI, I probably won't be buying any shares myself because I already own Chase, and that's more than enough exposure to banks during this economic environment, at least for me. All right, now guys, that leaves us with stock number 1, and no surprise here, if you guys know anything about Buffett, then you should already know that he is a huge investor in Apple, ticker symbol AAPL, as it makes up a massive 43% of his portfolio, equating to over $100 billion. No other stock on the list really even comes close. And there's not much to say here. Apple sells high-end hardware like iPhones, iPads, Mac computers, and laptops, and even things like watches and TV platforms, all of which are very popular and get their customers hooked on their ecosystem, which means they can consistently have customers upgrade their hardware or sign up for services, and that translates to huge amounts of money that Apple is able to generate fairly consistently. You're talking over $300 billion in revenue expected this year. That's pretty crazy. And yeah, Apple can sometimes be cyclical, like a 2% drop in 2019 and then a 22% climb this year, but the trend is always going up over the long term. And because they're so insanely profitable, they can just kind of keep investing in really whatever they want. I mean, there's talks of them building an electric vehicle and all kinds of different things. So they can always just kind of keep investing for growth and kind of keep that trajectory going up, again, like over the long term, if you can ignore some of that volatility. And the same can basically be said about their stock. You sometimes get some dips, a little volatility, but over the long term, it usually outperforms. And right now it's up over 400% in just the past 5 years. So really a well-performing stock. And they even pay a very tiny but decently high growth dividend as well. And despite all that, their valuation is still not anything too crazy either. In fact, on a GAAP basis, they're actually cheaper than the sector, believe it or not. So even though I personally like Verizon more at its current price and for the dividend, I have to put Apple at number 1 because the average investor, especially beginners, will likely be better off owning a larger, more stable, more profitable, and less risky stock like Apple over something like maybe Verizon. Even though, again, with my portfolio setup, since I already own similar stocks to Apple, I'd rather buy Verizon at today's prices. But anyway, there you have it, guys. That's the list that I've got here. That's how we're gonna rank them. I've got these stocks ranked as Apple number 1, Verizon number 2, CocaCola number 3, Bank of America number 4, US Bank number 5, Moodys number 6, American Express number 7, DaVita number 8, Kraft Heinz number 9, and then Chevron at the bottom at number 10. And I think I'm okay with that ranking overall. I do think that American Express and DaVita are a little bit low, so I would like to move them up a little bit, but really like stocks number 4 to number 8 could probably be moved around just based on personal preference alone because they are so similar in a lot of different ways. Personally, I wouldn't buy most of these stocks, but number 1, 2, and 3 are actually looking kind of attractive to me. So who knows, maybe some point in the future. And like I said, I do already own number 2, which was Verizon. Anyway, I hope you guys enjoyed the video. Let me know if you agree with my ranking, if you would make any changes to it, what would you move around? I'd love to read those comments and respond to them down below. Hope you're all having a great time out there. Hope you're all staying safe and doing well. I'll catch you guys in the next one. Take care. Bye-bye.